Hello everyone, this is Arun Arvind from Mentored Research. Today we have Balakrishna Sadekar, who's going to conduct today's webinar session. Um, Let me welcome Mr. Balakrishna Sadekar. Please take over.
Thanks, Arun. Can you guys all hear me? Arun, can you hear me?
Yes, I can hear you.
Okay, good. Thanks again, everyone. I'd like to thank Mentor Research for giving me the opportunity to teach you all these technical analysis courses. Hopefully, you guys enjoyed and learned something from it. My screen just went blank here. Hold on one second.
You
Okay.
are visible.
Oh,
Yeah.
good. Also, let me go ahead and apologize beforehand. I'm going to be coughing a lot in this presentation. I've been down under the weather for the last couple of days, so sorry about that. Today, what the plan is to just go over some stuff which was not kept in the course. So some points I've noted down. Hopefully, they will help you guys in doing the assignments or thinking about being a technical analyst in the future as a career and all that stuff. So, and again, feel free to ask questions. Let's see, chat. Arun, can you see the questions if they ask anything?
Yes. If
Okay,
they ask, the students ask questions, I can see.
all right, just let me know if somebody does because I'm not sure if I can here.
Ajin Sandroy, please say hi or something in the chat so that uh, I can be sure that.
Okay, good. I saw that. So, all
You saw
right.
that? Okay, that
Yes.
was me writing it. I'm thinking that once Ajin writes, we'll get to see his also.
Okay, good. All right, so let me just begin the presentation. As I said, nothing formal here. Just want to go over some points which I thought were important and not covered in there. So hopefully you guys can see the screen. Just let me know if you can't. Right now you should be seeing a slideshow, Technical Analysis Webinar 1. Arun, can you see the screen? I just want to make sure.
Yes, I'm
Okay,
on.
good.
I'll type it on the side.
All right, so let me start that animation mode again. All right. All right, so before this is the most important thing I want you guys to keep in mind is that this is an educational introductory course. Okay, this course is whatever you see in those videos is not a course designed to make you a trader. Okay, it takes years to master a skill to become a trader. So this course was designed keeping in mind that you guys need to get familiar with what technical analysis is, just to show you that there is another way to evaluate stocks and shares of companies, not just the fundamental way. This is a different way to do it, and most traders use technical analysis. Even though they might know how to do fundamental analysis, they definitely use some technical analysis to make sure that they are getting a good entry price into the stocks. But again, so keep this in mind. Don't try to indulge in the market after doing this course, because it is no way meant to make you a trader. Okay, it is just meant to give you the basics of what technical analysis is, um, and start you on that path to becoming a good trader. So keep that in mind. All right, I didn't mention any books in there. These are a couple of books which I have found really helpful. One is Technical Analysis Explained by Martin Pring, and the second one is Technical Analysis of Financial Markets by John Murphy. Excuse me. Both books are very well written. They explain stuff in great detail about all the, well, not all, but most of the indicators and oscillators that you have already seen. I believe there are 3 of them in the course. But they definitely go in depth in more indicators in there. One thing to keep in mind as I say that is,
Mr. Sadekar,
yes.
I think you're still on the first slide.
Oh, okay. You can't see the technical analysis book slide?
Not yet.
That's strange. Okay. How about
Okay, now
now?
we can. Now we can.
Okay, so I guess if I go in the slideshow mode, it doesn't show that. Okay, all right, I'll just keep it in this mode. All right. You can see it now, right?
Yes.
Okay. Okay, so as I was saying, when you start reading about the indicators and the oscillators, keep in mind that you need to just specialize in one or two of them. You definitely don't want to indulge yourself in 10, 15 of them and put them on your charts. It's definitely going to lead to analysis paralysis, and you will be stuck as to what you need to do. Some indicators might say it's a good time to buy. Some indicators are going to say it's not. So it's definitely going to lead to confusion. What I usually do is use either stochastics or RSI. Uh, Sometimes both, but most of the times it's just stochastics or RSI. I found those two indicators to be really good. So, but again, it depends on, you might like some other indicator. You might like CCI or any other. There's like 100 of them out there. It's just what suits you best. So keep that in mind. Don't need to indulge yourself in all of them. All right. The next point is just a brief thing about technical analysis. It is the study of charts, as you have seen in the couple of first videos. It provides us information on how the underlying instrument has behaved in the past. The idea of technical analysis is based on the fact that human emotions have not changed over the ages. Excuse me. So even 200 years back, 400 years back, when the Japanese used to trade rice futures, they still were subjected to fear and greed. Okay, there will be exuberation in the markets. There will be panic in the markets. So those emotions will not change even in the future. As long as humans are trading the markets, that will not change. And what the charts do is they show you that fear and greed as a representation of maybe a candle on there. And if these emotions of fear and greed, they will force the traders to react in the same way over and over again. So if there is a panic, people will react. People will have a herd mentality. They will start selling. They will not think twice. Okay, so keep that in mind. That's why charts work, and they will always keep working because human emotions don't change. And if somebody who is really, really into fundamental analysis tells you otherwise, please ignore that, because technical analysis really works. So knowing how the instrument has behaved around certain price levels gives us a clue about how it might behave in the future around those price levels. That might is a very important word here. Okay, will it always do it? No. Okay, there are plenty of times where it will not do it. Nothing is guaranteed in the market. Okay, say you have some issues with fundamental analysis because you come up with a price doing a fundamental analysis, but the market doesn't necessarily have to agree with your analysis, right? I mean, if a stock is at 32 rupees and you analyze it fundamentally and come up with a price of 40 rupees, doesn't mean that tomorrow the market is going to price that stock at 40 rupees. Absolutely not. Same thing with technical analysis. You think the stock chart looks good and it's a very good point to buy because its prices are going to be higher in the future. Need not be that the market agrees with you. The key is probabilities. Has that pattern occurred in the past? And if so, there is a very good chance that this is going to occur in the future. So you are looking at a very high probability scenario that if things have happened in the past, there is a good likelihood they're going to happen in the future. Okay, not every time, but most of the times. All right. Stocks move in trends. Okay, not all the time, but enough to profit from. A lot of times stocks will be in what is called a congestion zone. Okay, and I believe that should be in the videos too, where the stock just drifts sideways. Most traders who are in the market will make money when the stocks are trending. Okay, they do not make money when the stocks are in a congestion zone, because the movement of that stock inside a congestion zone is very random. Okay, there's nothing to go by. So people who are really profitable, who are really successful, they tend to lose a little bit of money in the congestion zone before they realize that it is in a congestion zone. Because remember, there'll be a time when you don't know it's in a congestion zone. The stock has been trending for a while, you keep making your money, and then at one point in time it will start a congestion zone pattern. Okay, but it takes a little bit of time. If you're doing like a daily chart swing trading, then it'll take a few days for you to realize that, hey, it's not trending anymore. It's moving sideways and looks like it's in a congestion zone. So until you realize that, these successful traders, they will lose some money. Okay. Having said that, this is the most important fact about the markets. Losses are guaranteed. Okay, profits are not guaranteed. Losses are guaranteed. So keep that in mind. It's only those traders who can take the losses, who can mitigate their losses. Those are the traders that succeed. Those traders who can accept the fact that losing is a part of winning are the traders who will be successful. Most people cannot accept that fact. I mean, especially people coming out from engineering backgrounds or science backgrounds, they know that, okay, they do a certain thing and the results should be such and such, right? I mean, if you do A and you do B, that should lead to C. That's how engineers or scientists think. There's no if and but about that. You do certain things, the results are guaranteed. It doesn't work that way in the markets. Okay, you do A and you do B, most of the times it should come out to be C, and you will make a lot of money. However, there will be times when the results come out to D. How you react when the result comes out to D is what is going to define you as a trader. Okay, that is where most traders fail. They let that loss that they experience when the result D happens get so large that it wipes out all the profits that they got when the results were the C that they were expecting. Okay, that is the biggest cause of trading failures, is letting the loss get out of hand. Excuse me, I gotta drink a sip of water.
All
right.
There is a question by Mr. Ajin Sin Roy.
Okay.
Can I bring him into the session?
Sure, yeah. Okay, I can see the question here. Typical stock chart over any time period shows many of the features of technical like double tops, head and shoulders, descending to and so on. Often these signs can be conflicting. How do you choose in such situations? Do you give precedence to the shorter term sale? Good question, Ajay. It depends on what time frame you are trading it.
Mr. Sadekar,
yeah.
I am trying to bring him into the call. You might continue with your session, and I think he got lost. So as soon as he gets in, I'll tell you.
All right, let's continue here. Are you seeing my screen here or not?
I'm seeing your screen.
Okay, good. All right, so the next point is the goal is to analyze these trends. And we can look at all the questions at the end of the presentation, I guess. We can do that. So.
Okay.
Excuse me. The goal is to analyze these trends and to find out how they visually appear on the charts. Because keep in mind, unlike fundamental analysis, technical analysis is mostly visual. So you are going to look at these charts and find those trends, find the patterns, and see how they started, how they ended in the past, so that you know what to expect in the future. Okay, and the most important point here is the exit. It is very critical to exit the position when the trend ends. Now, if you look at the psychology of the trader who's sitting on profits, you know, he's riding the trend going up, he's making profits, then all of a sudden there's a down day. There's a big down day wiping some of his profits off. What's the thought process there? The thought process is, okay, it's going to go up. It's been going up. Yesterday I had 1,000 rupees in profits. Now today I have only 500. That 1,000 was mine. I need that 1,000 back. So I'm going to wait a day. and let the market come up again tomorrow, and hopefully get my 1,000, and then I will get out. The market at that point is not, the market mostly doesn't have mercy on traders. So next day it drops down again, and now he's got only 300 rupees in profit. Now at this point, his chart clearly might show that the trend has broken. Okay, so if the trend has broken, the correct thought process should be that I need to get out with this 300 rupees in profit. The 1,000 was never mine. Okay, my system, my strategy tells me to get out at this point in time. I will get out. That should be the correct thought process, but that rarely happens. Ego steps in, greed steps in. Okay, those are human emotions. It's very difficult to get rid of them. You can only do it once you are in the markets for a long period of time and you slow and steadily master them. Okay, it doesn't happen overnight. So at that point, that guy decides, his ego comes in the picture. He says, no, I'm going to wait. I'm going to give it one more day and see what happens. At that point, the next day, the market swoons down and he's sitting on a 500 rupee loss at this point. So that's how good profits turn into losses. Okay, and if he has a little bit of smartness at that point, he will get out at that place. But most people will not. They will continue to hold it. They will continue to try and hope that the market comes up again tomorrow and at least reach break even at that point. You know, now they forget about the profits. Now it's all about getting to break even. And the market again is ruthless. It goes down again, and now you're sitting on a 1,000 rupee loss. So instead of a 1,000 rupee profit, which shouldn't have been his in any way, the 500 or the 300 should have been his. Now you're looking at a 1,000 rupee loss. So that's how the emotions will keep playing. The greed, the fear, fear of losing, fear of greed of losing the last few percentage points of the profit. So those are all the things that play on your mind once you're in the position. So the key is to have all those parameters written down in your trading plan before you enter the position, because once you're into the position, you are very emotional. Okay, very emotional at that point. All right, so let's look at the next one. All right, volume analysis. I haven't focused too much on the volume in the videos. It is also a very important point. It is, however, not a primary indicator. It is absolutely an excellent confirming indicator. Okay, it provides a way to see if the big money is participating in the trend. What do I mean by that? Keep in mind that the market has three phases. Okay, one is where the smart money. Okay, the smart money is accumulating stocks. As the stocks are moving down, these smart money people, they know what the right price should be. Maybe it's coming down to a really good support level like a 200-day moving average or a 200-week moving average. So the smart money is accumulating stocks. So that's the first phase, that these smart money guys now hold the stock. When that happens, now the big institutions, the big money comes in the stocks. Okay, and then you see the ramp up. Okay, the big money has enough force to start the initial ramp up phase of the stock. Okay, as the stock starts moving up, now you see the retail investor jump in. Okay, and the retail investor usually comes in towards the top of the trend. That is statistics. Most people don't know how to buy at the bottom. Most people come in at the top, and most people sell at the bottom. That's a well-known fact of trading. So at this point of the ramp-up phase, distribution, the third phase, starts here, where the smart money now starts to sell the stock to these retail investors. Okay, so first is the accumulation, second is the run-up, and third is the distribution. So now the retail investor is holding the stock at the top, and the smart money has made their money and they're out. So those are the three phases of the stock. So what tells you at the bottom that big money is coming in? That's the volume. Okay. Now in the next couple of weeks, I believe you are going to go through the candlestick course. Once you do the candlestick course, at least you get familiar with it. You have now at your disposal some powerful indications of when the stock might be doing a reversal, okay, going from a downtrend to an uptrend. So candlesticks, I use candlesticks all the time. It is one of the most powerful things out there. So, and we'll talk about more of that in the next webinar. But so volume is, you should always have volume on your charts. When you see some buying scenarios, you can look at the volume as a extra confirming indicator. It always helps. Okay. Also avoid low volume stocks. You don't want to indulge yourself in stocks that look like this. Okay, this is a candlestick chart which you'll learn in the next course. But again, the volume here is pathetic. Okay, so you can look to see on your charts and trade only the stocks which have very good volume in them, like Reliance or the big pharma, the big nifty stocks. Try to avoid the ones which have very low volume, because the patterns, there's just not enough psychology that gets built behind those patterns. Okay, and they can be easily manipulated. So even with just one person. So I tend to avoid most of those kind of stocks. You want as much psychology built into the chart as possible. All right. This is a very famous proverb on Wall Street. Bulls climb up the stairs and bears jump out of the window. What does that mean? It means that stocks take time going up, but when it goes down, when there is panic in the streets, the stocks can lose a lot of value very quickly. Okay, because keep in mind that when you have to buy something, you have the luxury of time. Most people have the luxury of time when buying stocks. You can think about it, you can sleep on it, and next day you can make your decision whether you want to buy it or not. However, when there is panic in the street, when there is blood in the streets, you don't think. Okay, most traders do not think. They join the herd. Everyone's selling, they will sell. Sell and ask questions later is how they say it. So that's why they say the bears jump out of the window. They don't take the stairs down. That's why it is extremely important to have proper stop loss settings. Okay, when you enter a trade, you have to have a point on that chart where you tell yourself that this is where I am going to get out. This is where the logic which I used to get in the trade is now negated. Okay, it's void. There is no reason to stay in the trade after the stock goes back down through this point. Other than that, it's just your ego that should keep you in that stock at that point. Okay, not logic, because logic tells you that, okay, this is the place. Let's say you did a bullish entry. It should tell you that. Let's look at the next example here, so I can. Here's a chart I believe should be in your course. This is JP Associates. Here's a head and shoulders formation. So a head and shoulders formation is a bearish formation. You already know at this point that once they break this neckline, that should now provide resistance in the future. Previous resistance, previous support proves to be resistance in the future. Okay, it's provided support back here, support back here. As the stock comes up, it provided resistance back here, it provided resistance back here. So if you're playing this chart, let's say you buy some put options on it, or you short the stock. When it comes back up, you are starting to panic because you shorted it here at this point, because you thought that, okay, the head and shoulders pattern had played out, the stock should move down. and now the stock's coming back up. What should be your logical place to tell you that your logic is negated, right? It should be up here, above this line. If the stock can convincingly, decisively close above this neckline, that should tell you that, hey, my logic is now negated. Okay, I need to get out of the short position or out of my put options. Simple as that. In this case, you would still be in there because it failed at that resistance point like it should, because that should provide resistance, so it worked out okay, not a problem. But if it had closed above this line convincingly, and I don't mean like by a half a rupee or something like that, I mean convincingly it closed above that, you need to get out. Simple as that. Most people, however, don't do that. They still hope that once it closes convincingly up here, they still hope that the next day it'll come back down, close below the neckline, and they'll be proved right in their initial logic, initial reasoning. Okay, it doesn't work that way. Okay, it might work sometime if you're lucky, but most of the times it ends horribly. Okay, it'll zoom up after that, and your losses will be very high. So when the chart tells you to get out of the trade, you need to get out of the trade. Okay, so that's very important. All right, next thing is this is one more a very important aspect of trading that traders have to know, is position sizing. Again, we don't go into the details here. I mean, that's that takes a lot of that's going to take a lot of in-depth analysis, but I just want you to be aware that this is one leg of your trading I guess your trading strategy. How many shares do you buy? Okay, very important question. There are two ways to do this. One is based on fixed capital allocation, and the second is based on a fixed stop loss. What do you mean by that? Let's look at the first one. Based on fixed capital allocation, you have, let's say, 1 lakh rupees to invest in the market. You want to do some swing trading, whereby you hold the position for a couple of days and ride the trend and get out of the position. So, in 1 lakh rupees, you want to divide it into 5 positions. Let's say 20,000 rupees each. So you are going to spend 20,000 rupees on each position. You can call them a unit. Okay, so you're going to trade 5 stocks and allocate 20,000 to each stock. Now the stock prices are going to have different. The stock prices are going to be different, right? I mean, one might be a 1,000 rupees stock and one might be a 20 rupees stock. So the way to do it is you divide the 20,000 by the stock price and you get the amount of shares. So you divide 20,000 by 1,000 and you get 20 shares. So for the first unit, let's say you'll have 20 shares of that stock. For the second unit, if it's like a 20 rupees stock, you'll have 1,000 shares. Okay. Keep in mind that the 1,000 rupees stock is going to move much more price-wise as compared to the 20 rupees stock. Percentage-wise, they might move the same, but price-wise, they're going to move a lot differently. What this does is it balances your portfolio, okay, by doing a fixed capital allocation. Now you have 20 shares moving a lot, and you have the 1,000 shares which move by a small amount, but they move the same percentage-wise. Okay. The second one, which I usually like to do, is based on fixed stop loss. So when you look at a chart and you are deciding to go into a trade, you already should know what your stop loss is. Where is the point on the chart where you need to get out of that trade? Okay. That is going to vary with the different positions that you take. Now on one chart in your entry system, you might find that, okay, if I enter at 50 rupees, if I buy at 50 rupees, at 49 rupees, it tells me that my reason has failed. Okay, I need to get out when the stock goes back down to 49. So in this case, your stop loss is 1 rupee. Okay, so what you can do now is, okay, that 20,000, you can divide that by that stop loss and get the amount of shares. Okay, in another case, you might say, okay, here's a 500 rupee stock I'm going to get in, and if it goes back down through 490, I know my reason has failed. I need to get out of that stock. So in this case, your stop loss is 10 rupees. So now you divide your 20,000 by that and get the amount of stock. So in both the cases, you will always have the same amount of stop loss. Okay, and that stop loss you can decide how much do you want. So it will always be the same in both the cases. So that's the one I like to follow, but it depends. If you like the first case scenario, that's easier to do, you can do that, or you can do the second one. Excuse me. All right, next one is the last thing I believe here is this is the most common question I've been asked in my last 8-9 years of teaching traders how to trade the markets. Can I make a living trading the markets? Okay, and I'm sure you guys have that question too. And the answer to that is yes, but with a caveat. It takes a lot of time, a lot of patience, and most importantly, it takes passion to be able to succeed in trading the markets full time. Okay, it takes an enormous amount of passion to continue to study the charts and continue to master your emotions and make a living, because it's relatively very easy. If you hold a job and you're trading the markets on the side, it's relatively easy to make money, because at that point you don't have the pressures of paying your check, you're paying your bills with the money that you earn from the markets. Okay, so there's no pressure on you. However, if you're going to be paying your monthly bills by making money in the market, that puts a lot of emotional stress on you, and emotions in markets, emotions don't tend to have good effects while trading the markets. So it's definitely doable. I know quite a few people who do it, but I know that they're full of passion and they have studied the markets for a very long time, day in, day out, to do that. You have to find a niche in the markets. Are you a swing trader? Are you a day trader? If you are a day trader, then do you have the personality to day trade? A lot of people ask me, can all the candlesticks that I teach, can they use it for day trading? I tell them, sure you can, but is your personality suitable for day trading? Because trading is 80% your personality and just 20% a system, from my point of view. Okay, there are a lot of systems that will work out there, but if you don't have the personality to trade that system, you're going to lose, you're going to fail. So keep that in mind. It's definitely doable, but it takes a lot of time and a lot of patience and dedication to master the markets. You're fighting against some of the smartest brains out there. So keep that in mind. Let's see, that's about it, I think. Do we have any questions?
Mr. Sadekar, you
Yes.
see the question by Ajahn Sen Roy on the side, right?
Okay.
You can take that up.
All right, typical stock charts. Okay, let me read that again. Over any time period shows many of the features of technical analysis, the double tops, head and shoulders, descending triangles, and so on. Often these signs can be conflicting. How do you choose in such situations? Do you give precedence to the short-term signal? As I just said, that really depends on what time frame are you trading. If you are seeing, usually what I do is I swing trade. Okay, so I'm looking at a daily chart. Okay, all my candles are daily time frames. So if I'm trading a daily chart and I see a head and shoulders, you see the latest pattern. What is the latest pattern in there? Okay. One more good thing to do is look at the weekly chart too. In case you're trading a daily, but on the daily you see a double top formation. Okay, but which double top formation, which is a very bearish pattern. Okay. However, when you look at a weekly chart, it's in a very bullish pattern. Okay, the weekly trumps the daily. The daily trumps any hourly chart. And the hourly chart trumps the 5-minute chart. Okay, the higher the time frame, the more powerful the pattern is. So if you are going to trade a double top pattern on the daily chart in a very bullish weekly chart, then it's an issue. Okay, because it might not go down as much as you expect it to go down, and the bigger investors might come in at any point in time to support that stock and continue its uptrend. So I like to align the daily with the weekly. So look for a chart on the daily where it's showing a double bottom formation in a bullish weekly chart. You see what I'm saying? It's like, don't try to swim against the market. The bigger tides are going to dominate the market. So you want to align your smaller currents with the bigger tides. That's the best way to trade the markets. Can you make money trading the double top? Sure you can, but you'll have to be much more nimble in that case and get your profits much more faster than in the other case. Okay.
I don't see there's any other questions, but I'll try to bring in one of our students, Rohit Anand, who's on the session. Rohit, I'm trying to bring you in. We are unsuccessful on this, then we will close stuff with.
Do you need me to stop the screen sharing? Maybe that's the reason you can't get in.
I don't think that should.
Let me stop this. I'm done anyway, so let me stop it. See if you can get in now. Okay, you can take the.
Yeah, let me see. Are you able to pull the market charts on the session? Maybe for a future session you can look at like a live market.
Yeah, once they know the candlesticks, then I think that would be a good thing to show. So that'll be better. Yeah, in the next webinar I can show the candlestick charts and you can do some live things.
Yeah, Rohit is on the call. Hello, Rohit.
Hello, Rohit. How are you doing?
Hello, sir.
I just wanted to make use of this chance to introduce you to Mr. Sadekar face to face. If you have any questions, how are you feeling about the course, those kinds of stuff, you might want to tell it to Sadekar.
How are you doing, Rohit?
Sir, the course is great, but like I haven't got the time to go through that whole slides one more time because currently now I'm doing an internship at Tata Motors.
Oh, okay.
So I didn't get the time to. I did study up till that moving averages only. So once I'll study more, then I may contact you.
Absolutely. Feel free to send any questions whenever you want. So.
As you know, there is the query at mentoredresearch.com email ID. Send your questions into that.
Okay, sir.
Mr. Sadekar will have another webinar session 2 weeks from now, and you will have opportunities to ask him questions at that time also. Okay. I will be sending him the recording of this session, just in case you missed some of the parts. You can look through them also and take this opportunity to learn more.
Okay.
Yeah.
Sounds good.
So, Mr. Sadekar, looks like there is nothing else for the session. So maybe it's, you can say what do you call bye-bye message or whatever, and we can close this call.
All right. Do you hear me now, or?
Yeah.
Okay, good. Well, hopefully you guys, everyone will get a good feeling of what technical analysis and benefit from it. So there's plenty to learn in technical analysis. This is just scratching the surface. So, but again, if you have questions, feel free to send them, and I'll be happy to answer. So, okay, we will see you again 2 weeks from now. Hopefully, that seminar on candlesticks, that's very close to my heart. So that'll be more interesting. So.